if anybody here remembers June of this year, and Carolyn Wilkins roiled financial markets when she tipped off the argument that the next rate hike was in the offing. So, and I quote, "As growth continues and ideally broadens further, Governing Council will be assessing whether all of the considerable monetary policy stimulus presently in place and is still required," she said. She also added, "If you saw a stop light ahead, you would begin letting up on the gas to slow down smoothly. You do not want to have to slam on the brakes at the last second. Monetary policy must also anticipate the road ahead." So I think we all here agree that central bank communication can be difficult sometimes, not only from the point of view of central bankers, but also for financial market participants. So there was a whole conference at the ECB earlier this week and it was devoted to communication issues. So we would be very pleased to hear, from the standpoint of the Central Bank of Canada, how do they deal with communication issues and what are the challenges. So Carolyn Wilkins was appointed Senior Deputy Governor for a term of 7 years in May 2014. She is a member of the Bank Monetary Policy Setting Governing Council and a member of Bank's Board of Directors. In her role as a senior deputy, she also oversees the bank strategic planning and economic and financial research. Ms. Wilkins represents the bank on the Financial Stability Board plenary, its regional consultative group for the Americas, and its standing committee on assessment of vulnerabilities. She previously represented Canada on the Basel Committee on Banking Supervision. Ms. Wilkins has been with the bank since 2001. Prior to her appointment as a senior deputy, she was advisor to the governor, and prior to that, chief of the bank's Financial Stability Department and deputy chief of the Financial Markets Department. She was born in Peterborough, Ontario, and holds an honors BA in economics from Wilfrid Laurier University and an MA in economics from the University of Western Ontario. In 2016, she was named one of Canada's top 100 most powerful women. Ladies and gentlemen, Carolyn Wilkins.
Well, thank you very much for that kind introduction. I'm going to try to steer away from car analogies tonight. So uncertainty, I think it's fair to say, is just top of mind for many people. And whether it's about trade agreements or it's about job security in the face of increasing automation, or it's about threats from geopolitical tensions in all parts of the world, uncertainty is top of mind. And at the same time, we've got economic news in several advanced economies that has actually been surprising people on the upside recently. So it's in this context that many people feel like the world is becoming more and more uncertain, and Canada is no exception. For central bankers like me, there's nothing particularly new in this, even though the sources of uncertainty and concern can be changing over time. And this is evident. I mean, we're talking about it at dinner. To those who remember the oil price shock in the 70s, some of you may be too young, but some of us aren't. Or Black Monday in the 1980s. I mean, there's just been this host over the decades of disruptive events or major sources of uncertainty. And so the central banker's job has just always been to steer the right course for monetary policy in the face of uncertainty. And today, some central banks are contemplating shifting gears. So it's going to be critical to understand how uncertainty is actually factored into monetary policy decisions if you want to understand and anticipate policy actions. In my remarks this evening, what I'd like to do is dig into these issues and in the context of Bank of Canada policy. And your organization, the Money Marketeers, is just the perfect place to do this because you're dedicated to fostering discussion of what are really relevant policy issues. So thank you very much for the invitation. So I'm going to motivate my remarks around 3 observations that I've explored in more detail in a discussion paper that's going to be published soon, I think maybe today. And I worked on this paper with a couple of colleagues at the Bank of Canada, Rhys Mendes and Stephen Murchison. And put simply, I'm going to talk around 3 observations, and these are that uncertainty is a fact of life. Monetary policy can become asymmetric when uncertainty is embraced. And the third is that uncertainty is not a reason for paralysis in decision-making. It's no surprise that our work uncovered areas where further research is necessary to improve the framework in dealing with uncertainty, and so I'm going to get to that too. So I'll start with my first observation, and that's that uncertainty has always been a fact of life for everyone. And like many businesses and households, central banks have established techniques to reduce the level of uncertainty where that's possible. The Bank of Canada has devoted considerable effort to reducing uncertainty by being clear about the objectives of monetary policy and the framework to achieve those objectives. And the inflation and control agreement that we have with the Canadian federal government, which is renewed every 5 years, has been in place for the last quarter century. And what this agreement does is it provides a clear objective for monetary policy, but also operational independence for the bank. So we also invest continuously in state-of-the-art forecasting models. And just as an example, we recently updated one of our main projection models to include a richer role for indebted households in the transmission of monetary policy. And this is a timely innovation, given that household debt has increased notably in Canada in recent years. We use competing models to inform our deliberations whenever possible. And this is like getting your investment advice from more than one broker. We're exploring multiple sources of data, I think just like everybody else, big data, surveys, to really improve our real-time reading of the economy. Now, it would be fabulous if these research efforts could eliminate uncertainty altogether, but the real world isn't so obliging. And the reality is that researchers are aiming at a moving target, given ongoing structural change in the economy, just for example, the aging population. And there's also the possibility that research have to deal with truly unexpected events, like natural disasters. You're forecasting in that environment, it means that there's a considerable degree of uncertainty that is irreducible at any given point in time. And in the current context, the Bank of Canada is particularly focused on data that indicate how wages and potential output are progressing, or the effects of the 2 interest rate increases that we made this summer. And not surprisingly, we're following trade negotiations very closely. So how does the Bank of Canada deal with this irreducible uncertainty in practice? And well, it's not surprising, like many central banks, we use projection models that capture the key economic relationships out there, and we produce a forecast. And this forecast includes a monetary policy actions that are likely to be needed to return inflation back to the 2% target over the projection horizon. Now, the necessary policy actions are generated by what we call a simple monetary policy rule. And this policy rule captures the bank's average historical behavior. It's just an equation that's estimated. And it doesn't change with the level or the sources of uncertainty. And because of that, it's as if uncertainty has been set aside. Okay? And it's closely related to what's known in the monetary policy literature as certainty equivalence. Now, certainty equivalence is akin to aiming for the bullseye, even though you know there are winds out there that are going to push your arrow in some unknown direction. It's a really useful starting point. It's an important starting point, but it's insufficient. In fact, there's a rich economic literature out there that shows why this framework applies only in a limited set of circumstances, and those circumstances don't look very much like the real world. Now, market participants here are going to know firsthand what I mean, because sometimes volatility can affect investment behavior even when it doesn't affect expected returns. Some investors, in order to avoid tail risks on the downside, are going to forego higher expected returns. And whether you're an investor or a central banker, you're going to want to quantify how best to respond to the uncertainty by using your knowledge of the type and degree of uncertainty that you're facing. And that's very manageable in many cases, but it's a tall order in others. And in practice, we're faced with uncertainty about the retreat from globalization, threats to peacetime relationships, and we're also faced with uncertainty of a more positive nature at times. For example, the promise of digitalization for productivity growth and the promise of structural reform for emerging economies. So we're even faced with scenarios in which the range of outcomes are unknown. And in these cases, statistical estimates are obviously of limited help. I think the current uncertainty that's surrounding the future of NAFTA and the related policies around that is a case in point. And what we've done at the Bank of Canada is we've incorporated the effects that of uncertainty that businesses face on their investment decisions and on exports to better balance the risk to our forecast. At the same time, we've assumed no change in the trade agreements in the base case. And aside from the estimated uncertainty effects, we haven't factored possible changes in trade agreements into our current stance of monetary policy. So instead, we're following the developments closely. We've mapped out the main channels of transmission that would come with increased protectionism, and we're sharpening our models so that we can incorporate any concrete developments in the projections should they occur. So I think this approach is very consistent with how many central banks deal with things. It's certainly consistent with how we've treated uncertainty surrounding other trade agreements, like the trade agreement we have with Europe and the TPP. And so in practice, we start with a formal framework that's consistent with certainty equivalence, and then we apply judgment to account for the main sources of uncertainty that are considered missing from the framework. And this leads me to my second observation, which is monetary policy can become asymmetric when uncertainty is taken seriously in policy design. And this can lead policymakers to deviate substantially from the simple world of certainty equivalence and what their simple monetary policy rules are telling them. And it's here that I believe that our understanding of how this happens and why this happens can greatly benefit from cross-checking our logic, our rationale, with the economic literature on how to conduct monetary policy under uncertainty. So to illustrate why I think this is helpful, I'm going to discuss two situations that are particularly relevant in the current context. And the first situation leads to more aggressive policy actions. And the second situation leads to what is often referred to by central bankers as caution or patience. Now, the first situation is best illustrated by considering how monetary policy is conducted when interest rates are close to the effective lower bound. Okay? So we all likely remember, or at least some of us do, when central banks, including the Bank of Canada, reduced interest rates very aggressively when financial markets seized up in 2008. Now, knowing what we know today, and that the biggest global recession since the Depression was about to begin, well, these policy actions seem self-evident. I can tell you they were anything but self-evident at the time. And when we compare our policy actions at the Bank of Canada with what would have been prescribed based on our past behavior, we can see that the response was exceptional. You can do a calculation and see that the Bank of Canada eased monetary policy significantly more and by as much as 2 percentage points more at one stage than a policy rule would have told you at the time. And this increased aggressiveness is a textbook example of optimal policy when there's a possibility of being constrained by the effective lower bound. Now this constraint is, it's true, this constraint is mitigated by the availability of unconventional policy tools, but it's not eliminated because there's considerable uncertainty about their effectiveness. Now the bank's actions 10 years ago reduced the chance that this constraint would bind. And we did this by generating additional economic momentum going into the recession. So even though GDP and inflation fell, it fell by less than it would have if the pace of interest rate changes had been less or slower. And so as a result of this, the only unconventional tool that the Bank of Canada ended up needing, there were other reasons too, was to use communication and the extraordinary forward guidance that came in the form of a conditional commitment to leave rates unchanged. So what can we draw from this? Well, I think the principle that we can draw from this experience is that policy should respond more aggressively to negative shocks when we're near the effective lower bound than when we're far from it. And it's also asymmetric in that policy responds more aggressively to negative shocks than it does to positive shocks. And the reality is that we're going to be closer to the effective lower bound more often than in the past because the neutral rate of interest rate is lower than it was in the past. Based on our assessment that the effective lower bound in Canada is minus 50 basis points, the probability of being at the effective lower bound is about 5 times higher than it was 15 years ago. So, while more aggressive policy may be optimal, central banks could potentially achieve better results if they were more confident about the effectiveness of unconventional policy tools. And that's why I think it's just so important that we refine the design of unconventional policy tools like quantitative easing and others, and deepen our understanding of the strength of their transmission to the real economy. So there are also times when uncertainty can lead to caution or patience. And this is my second example. And just 3 weeks ago, the Bank of Canada decided to leave the policy rate unchanged. We said at the time that while less monetary policy stimulus will likely be required over time, Governing Council will be cautious in making future adjustments to the policy rate. And one of the motivations for caution is the fact that inflation has been at the lower end of the inflation target bands of 1% to 3% for quite some time. And to see why this might matter, it's helpful to recall why these target bands were chosen in the first place. And the 1% to 3% target range primarily reflects a recognition that there's a degree of imprecision associated with inflation targeting. And while some normal fluctuations can be expected within that range of 1% to 3%, often they come from gasoline prices, well, central banks may become disproportionately more concerned with the prospect that inflation might fall outside the range. And this is referred to in the economic literature, for those who are interested in that kind of thing, as a kinked loss function. And what this means in plain language is that a central bank may put a greater weight on the downside risks when inflation is low to begin with. And what's important to note about this line of reasoning and why it's so worthwhile to think it through is that it also applies to situations in which inflation is close to the upper part of the inflation target bands. So even if inflation were in the middle, closer to the middle of the band, and the effective lower bound wasn't a constraint or a consideration, caution may still be in order. And in Canada, one reason is that there's currently greater uncertainty about the strength of the monetary policy transmission mechanism. I mean, higher household debt has likely increased the sensitivity of spending to interest rate increases, but it's difficult to know right now just by how much. And there's also uncertainty about the interaction of interest rate increases with the recent tightening in macroprudential rules. So the logic behind caution in this case is often referred to as Brainerd's principle of attenuation. There's a great paper in 1967 for those who are interested in that kind of thing. And what it says is that policy should change less than it would if the central bank were more sure of the effect of their actions on interest rates. Now, another reason for caution, and this is maybe more of a wait-and-see approach in the literature, is related to a desire to avoid having to reverse policy abruptly in the future. Since the adoption of the inflation target and the fixed announcement dates that we had at the beginning of the century, the Bank of Canada has changed policy interest rates 46 times. I don't know if you knew that. But only 4 of these were a reversal within a 6-month period. And, you know, it may be because cycles are persistent. But certainly if you look at the behavior of other central banks, it's very similar. And it's therefore not much of a surprise that other central banks have also cited uncertainty as a rationale for waiting. Now, for the business people in the room who have ever considered a large capital investment, this reasoning may sound actually quite familiar. It can be useful to have the option value of waiting when you are not sure of the returns. And this is probably particularly true if the investment is largely irreversible. So, as with an investment, the fixed cost of changing policy direction may explain a central bank's aversion to reversals and motivate a wait-and-see approach. And you know, I think after saying that, I still need to have a caveat, which is it's unclear just how costly policy reversals are for the real economy. It could be that the perceived costs are self-reinforcing because reversals are so rare that they are viewed as errors, policy errors, when they actually occur instead of a sensible reaction to new information. So it leads me to my final point, which is uncertainty is not a reason for paralysis in decision making. And whether it's about how aggressive or how cautious policy should be, getting the dosage right really demands sound judgment about complex trade-offs. Just think about my last example about the wait-and-see approach. In central banking, there's no equivalent to the late mover advantage. But even for a business, delaying investment too long leaves it vulnerable to the competition. So checking the logic of this judgment that allows you to make these trade-offs, it's important to check it through modeling, formal modeling exercises. I just think that's good practice. So it helps to inform our assessment of these trade-offs, and it also supports decisions that stand the test of time. And that's why the research effort at the Bank of Canada is focused on some key areas. And for instance, we're working on how to better model the dynamics between the real and the financial sides of the economy. I mean, particularly triggers for financial instability. That continues to be a blind spot. There's also significant work underway studying inflation and wage dynamics, and Governor Polas talked about that in Montreal last week. We have a longer-term objective, which is how to incorporate the effects of uncertainties that households and businesses face in their own decision-making inside our models. That's not in there right now. I think these efforts will pay off because they're going to improve the base case projections. And we always supplement our base case projections with model-based risk scenarios. And one example came out a couple of weeks ago where bank staff published an alternative scenario in which the economy's potential grows faster. We're focusing our efforts as well on designing policy rules that get out of that certainty equivalence world and are more robust to the types of uncertainty that we encounter every day. I think strengthening this policy framework will not only support sound decision-making, but also transparency and confidence. To understand why policy actions were taken and what actions might be in store, you need to understand not only the base case projection, I mean, I think that's pretty obvious, you need to understand how we factored uncertainty into our decisions. And we have numerous ways to explain these two elements. They range from discussion in the risk section of the bank's quarterly monetary policy reports to the opening statement that is made at the press conference that follows the release of this report. We also have speeches like the one I'm giving today. And we've decided, starting next year, to advance the timing of our quarterly economic update speeches to align more closely with the fixed announcement dates that fall between monetary policy reports, where we don't have a full projection. And these speeches are going to be given by governing council members and will be followed by a question and answer period with the media. Now, of course, no communications tool will be effective if we don't reach our audience, and that's why we continue to advance our digital strategy to communicate ways that really match how people today prefer to receive their information. So it's time to wrap up. Uncertainty is a fact of life for all of us, and central bankers, we have well-established methods to deal with it in the conduct of monetary policy. And when uncertainty is taken seriously, it can lead to asymmetric monetary policy responses. I explained why policy may respond to negative shocks more aggressively than usual when near the effective lower bound on interest rates. I also explained why during periods of uncertainty like today, a cautious approach might be more prudent. Now, caution has its limits, and that's because there are complex trade-offs, including those related to financial stability. So the Bank of Canada is investing heavily in research that will help better quantify these trade-offs and interaction with macroprudential measures. And as we move forward, it will be critical that people like you and other central bank watchers stay engaged to share your own ideas about how we could further strengthen the framework for conducting monetary policy under uncertainty. Thank you.
Hi. Thank you for those remarks. Let me see if I can summarize a little bit some of the ideas you had. That uncertainty means proceed with caution, thus Fed always using the word gradual. An objective is 2% inflation, give or take a little bit within the range. And in order to achieve that, you use models to try to, help you pinpoint the right, you use the word dosage, I kind of like that. But my problem is that the models, and I'm thinking of the Fed at this point, have been abysmal in terms of forecasting productivity, inflation, growth. They don't know why they've been weak. They don't know why this huge amount of monetary global stimulus has not really led to the amount of inflation that it wants. So the one thing you didn't talk about in terms of that dosage, which has been big, is the time inconsistency. In other words, how long, you want to make everything better today, and you want to try to achieve that 2% target today, and the longer you're at this, you're sort of mortgaging the future in terms of, indebtedness that's building up. And how does the risk to financial stability and those arguments that you've heard, also something you didn't, weigh into getting it right, that dosage, more in the long term than in the short term?
Yeah. Well, there's a lot in that question. I'm going to take it. You just articulated what we think about, and so let me just take it in pieces. Though, it's true that no single model, or even collection of models, are going to tell you every time what's going to happen exactly. In fact, who here has forecast? I used to be a forecaster. All I knew was for sure almost that my forecast would be a little bit wrong or a lot wrong, but it would very rarely be exactly right. Okay. And I think that nonetheless, when you look at forecasting performance over time for the Bank of Canada and stuff that matters, so let's say GDP growth and inflation, yeah, we make errors, the errors aren't any bigger than they were 20 years ago. It's surprising. You think they were. They were really big over the crisis, but in fact they're not. And so I think that's one point. The major thing that's missing from the models, and I touched on it, is this relationship between the real side of the economy and the financial side. Because where that transmission of the crisis, for example, where that played out and why it took so long, I think, for the economies around the world to recover, because balance sheets needed to adjust, right? And that balance sheet channel where people who have too much debt need to get rid of it, banks that don't have great assets needs to figure out how to reprice them and shrink or whatever they need to do, sell them. Those kinds of dynamics, which end up being a drag on growth, are not actually in the models, and that's where the judgment comes in. And I think that you look at the Bank of Canada, we were disappointed kind of repeatedly on the growth side, and a lot of that came from being maybe overly optimistic about how quickly the U.S. and others would recover, and that feeds into us, and just how important those balance sheet channels are. So I'm in total agreement with you that that's where, if we're going to work on models, we need to do it. I mean, I think the judgment comes in exactly where I talked about the trade-offs. I mean, clearly we know that monetary policy by design works through credit. That's how it works. And so unless fiscal policy does it, you kind of have a choice whether you have fiscal deficits increasing and debt increasing, or you have households and business becoming more indebted. That's the choice. We take fiscal policy as given and stimulate the economy through our traditional channels. I think when we look at financial stability, though, we need to be very careful to match the tool with the problem. And monetary policy has a goal of targeting inflation in Canada. We don't have a dual mandate, but even if we did, I think my answer would be the same. When you're looking at financial stability issues, you need strong micro-prudential tools, and you need macro-prudential tools that actually go in and target where the problem is. And for Canada, the federal government and some of the provinces have been taking actually quite concerted steps over the last number of years to tighten mortgage financing rules, for example, improve the quality of debt that's out there. And it's early days for the most recent one, but they look like, when you look at the micro data, that they've actually been quite positive for increasing the quality of the debt. So I guess my answer is there are trade-offs when it comes to monetary policy. Monetary policy can't do everything, and its goal is primarily to target inflation, and these other tools, microprudential and macroprudential, sound financial regulation, are what helps you most when you need it on the financial stability side.
Hi. Thank you for fantastic comments, Dr. Wilkins. Two questions. One, to what extent does maybe the Bank of Canada look at financial conditions and how that may play a role in the monetary policy process? And two, you talked a lot about uncertainty, and we're very articulate about it. The Fed seems to be becoming more certain about, at least in the near-term outlook. The Bank of Canada is cautioning much more about uncertainty in the near-term outlook. Traditionally, the two economies follow each other. What's different this time, NAFTA aside, but what's different this time for Canada in terms of the Canadian-U.S. central bank relationship? Thank you. So
I'll answer your last question. I'll answer your last question first. So you need to remember that following the crisis, Canada and the U.S. Started to recover actually quite smartly at one point, and then oil prices dropped, went from $120 to under 40 for a bit. And for the U.S., that's hard for a certain part of the economy, but it's not a negative terms of trade shock like it is for Canada. And so just from a cyclical point of view, we experienced a very severe adjustment in the oil patch and related sectors. Business investment in total tumbled by about, I think nearly 60%. And so kind of going through that was facilitated by a couple of monetary policy actions. We reduced interest rates by 50 basis points in total to help that adjustment. And so we're coming out of that. You know, in July I said that we're seeing that being you know, largely behind us, and we could see the 70% of the economy that's not related to resources really taking center stage, and the oil sector kind of leveling off as well, and so it was the right time with the output gap closing to start taking the foot off the pedal, reduced stimulus as opposed to tightened, if you want to put it that way, and so I think that just puts us at a different part of the cycle in terms of you know, where we see the economy going and where inflation is. The output gap is just basically now virtually closed. We've got still have slack in the labor market, and so for that reason, I think it's important to articulate where we see the uncertainties and be really clear about what we're looking at. We've got 4 things we're looking at. I mean, there's more than that, but and going forward, as I said, uncertainty isn't you know, a reason for paralysis in decision making, but it is a reason to think about things carefully.
Hi, Senior Deputy Governor. Just a question regarding the cautious narrative with regards to monetary policy. When we look back at the back-to-back hikes that the bank delivered, it sent a signal to the markets that the bank was behind the curve. And then 4 weeks later, the bank is preaching caution. And from what I can tell today, it suggests that the bank is more inclined to let the economy run hot before normalizing interest rates further from here. Is that consistent with the cautious framework that you're discussing today? And certainly, is it make it more unlikely that we see another back-to-back delivery of monetary policy tightening as well? Thank you.
Well, I think what we saw at the beginning of the year was quite strong growth. If anybody pays attention to the quarters, in the second quarter, we got growth of 4.5% just right before our September decision. And we said we were going to be data dependent. And so with the output gap nearly closed, it seemed like it was very appropriate to take out another one of those interest rate cuts that we had done. That being said, there was no sense at the time, and even now you see in our October report that we felt like that pace of growth was sustainable and was going to continue to grow. So what we're seeing and what we're expecting is some slowdown in the economy, moderation in the pace of growth that is more in line with potential output growth. That wouldn't be a surprise or a source of caution for us. It's really looking forward, given what we've done, to think about, okay, well, what's going to be the effect on spending, particularly at a time when we've had macroprudential tightening. I don't know whether everybody in the room follows this, but our superintendent has taken steps to increase the stringency of stress testing of households that are looking for mortgages that have a really big down payment, that don't need mortgage insurance. And they're doing this just to make sure that people that take on that debt have a more solid base to withstand interest rate increases. Of course, that's going to have an effect on, that was announced just recently, in fact, just right before the monetary policy report, and it's something that we estimate will take about 0.3 percentage points off of GDP. And it's really a question. I mean, it's a very good policy to increase the sustainability of debt that is out there and the quality of debt that's out there. But at the same time, there's an interaction with monetary policy that I'm sure everybody in the room understands. It doesn't have a long history, and so I think it warrants just watching that, and you combine that with was something that we'd actually talked about well before September, which is just kind of what's going on with inflation. We believe that we have a very good handle on what's happening with it. We've got people who look at it with a fine-tooth comb, who have estimated all kinds of relationships and explored many, many alternative explanations. And you know, our baseline is that inflation is going to go back to 2%. You know, in the latter half of 2018. But there is some uncertainty there, and I think we would be, it's an uncertainty that's global, that comes from perhaps a changing dynamic inflation, that comes from globalization, that comes from perhaps digitalization, online spending. And so you think that, you know, I think it's a prudent thing for a central bank to take that uncertainty about the inflation process seriously, and watch the data.
Thank you. I think we have time for just one more question. So
I'll try to make it a good one. Thank you for your comments, Governor. One thing I noticed that was sort of missing from your remarks tonight that we've gotten from some other of the bank's communications recently is what you could call this sort of high-pressure economy view. The idea that if you let the economy run a little hot, that demand may create some supply, may create productivity, may add to investment. And that seems to be, in addition to uncertainty, one of the reasons expressed by the bank for waiting a bit now. And I'd be curious your own view on this sort of high-pressure economy debate that's been kind of on and off among developed market central banks for a while. You know, how do you look at the Canadian economy in that light today? Is that a reason for additional policy patience right now? Thanks.
So we've been very clear that we target 2% inflation, and that we will take actions that will get us there. And so this idea of hot or not is not really embedded in that. It's not relevant for that. I think you can still talk about potential output in another way, and this is the way in which we've talked about it, which is in our forecast, we need to project where we think potential output is going. And we all know in an upcycle that you get a cyclical upswing in productivity, closer to trend if you've been below it. And the same with labor participation, the same with the investment that builds your capital stock. And so it's for that reason that we think that what we tend to do over an upswing is underestimate the amount for which we're going to be building productive capacity. And it's not really about running the economy hot or not. It's just what happens when you get the virtuous circle of growth, and a virtuous circle that's in Canada that's combined with more synchronous growth globally. It's not something you would want to build into your base case, because if it doesn't happen, then you've got risks on the upside to inflation, but it's something that you want to take on board and watch in terms of your assessment of the risks around your inflation forecast.
Okay, thank you so much, Deputy Governor. Thank you very much.